I've so been looking forward to hosting this session with the legendary Mark Mobius. The founder of Mobius Capital Partners, Dr. Mark Mobius, has spent over 40 years working and traveling throughout emerging and frontier markets. During his time, he has been in charge of actively managed funds totaling over $50 billion in assets. Prior to launching Mobius Capital Partners in May 2018, Dr. Mobius was with Franklin Templeton Investments for more than 30 years, most recently as executive chairman of the Templeton Emerging Markets Group. During his tenure, the group expanded its assets under management from 100 million to 50 billion and launched a number of emerging market and frontier funds focused on Asia, Latin America, Africa, and Eastern Europe. In addition to open-ended and closed-ended mutual funds, he launched a successful series of emerging market private equity funds. Prior to joining Templeton, Dr. Mobius was chief executive of International Investment Trust. Dr. Mobius has also been a key figure in developing the international policy for emerging markets. In 1999, he was selected to serve as on the World Bank's Global Corporate Governance Forum as a member of the Private Sector Advisory Group and co-chairman of the Investor Responsibility Task Force. He's been a member of the Economic Advisory Board of the IFC and has been on the supervisory board of OMV Petrom in Romania since 2010. Previously, he served as a director on the board of Lukoil, a Russian oil company, and Dr. Mobius's career and influence has earned him some numerous industry awards, including a Lifetime Achievement Award in Asset Management in 2017 from Global Investor Magazine, 50 Most Influential People by Bloomberg Markets, Africa Investor Index Series Awards, Top 100 Most Influential, and the list goes on. Dr. Mobius is absolutely a legend, someone that I personally admire and have been following throughout my career and in my early days as I've been interested in investing in markets. It's such a pleasure to have him here today, and along with an audience of nearly 400 people from 51 different countries. We actually have over 100 different members also representing from the YPO organization, an organization that I'm proud to be a member of as well. So it's such a pleasure to have Dr. Mobius on today. And without further ado, I'd love to introduce and hand over to Mark. Before actually I hand over, please be aware there is a Q&A. Please send your questions. This is meant to be a live interactive discussion. The idea is that everybody can walk away from this feeling that you just had a conversation, a personal conversation with Dr. Mobius. So please be sending the Q&A. I will be moderating the Q&A and asking questions on your behalf and on behalf of the audience as we go on. Mark, please tell us what are your thoughts on what's happening in the markets today? What's your outlook, and how are you feeling about the markets as they are?
Thank you very much for that wonderful introduction. It's great being with you, and I'm looking forward to all the questions that people may have. I love these surprise questions because it makes it more interesting and fun. As you know, I'm here in Munich, Germany. I was repatriated courtesy of the German government from South Africa. I was in Cape Town and then in Durban. And of course, if you were in Durban during this time, you'll notice that they've had almost a military style shutdown. It's been very, very tough. So it was a pleasure to get out and to be here in Munich, because now at least I can walk on the streets and go cycling along the river and so forth and so on. So it's a lot better. But I'm looking forward to getting back to Dubai, as you know, because I have an apartment there, and also in Singapore, where I spend a lot of my time. But anyway, let me give you a little background on where we are now. As you heard, I've been working in these emerging markets since 1987, when we started the very first listed emerging markets fund, the Templeton Emerging Markets Fund. And before that, I was in Taiwan, Hong Kong, a number of other countries. But we decided to go off on a new path related to ESG, environmental, social, governance standards. Because what we found that there were two very important developments taking place in our business, in the asset management business. One development was, of course, the incredible spread and increase in assets in ETFs, exchange traded funds, index funds generally. I mean, the growth in that category has been astounding. And of course, as a result, less money has been going into actively managed funds. So that is one big development that we notice. And we also recognize that a lot of the active managers, including ourselves, were tending to move towards an index orientation. And of course, we figured that, look, given the fact that active managers are going to be paid a lot more in assets under management, in terms of the percent of assets under management than an ETF, the game has got to change for the asset managers, the active managers. So we found that also companies that did well on ESG, particularly the G, the governance aspect, did very well. They did much, much better than just regular index funds or other actively managed funds. So we established Mobius Capital Partners to focus on that. And we came out with a book called Invest for Good. And basically, sort of has a double meaning. Invest for good in the sense of try to do good with society, but also invest for good to take a long-range view, not a short-range view. And the emphasis, of course, was on the G, because we figured that if you are going to improve the E, the environmental aspect, or the S, the social aspect, you've got to be good on the governance side. And again, the studies that have been done on this topic indicated that companies with a high ranking on governance, good governance, did better in the market. Their performance was better. So we started a fund, actually two funds, a CCAV in Luxembourg and a trust, investment trust in the UK, designed to, number one, focus on the G of governance. And of course, in the book, Invest for Good, we give a number of examples, passive examples of our experiences in helping companies improve the G, the governance. And then we decided that we had to focus on fewer companies. So our portfolio, we figured, should not be over 25 stocks, so that we can really work with companies on a one-on-one basis to help them improve the governance. Of course, many people say, do you really think you can improve governance in companies? Will they listen to you because you're small? I mean, it's true that we're at this stage quite small, not, we don't have billions under management. But our experience has been that probably about half of the companies we talk to are very receptive, particularly when we tell them, look, we can help you improve your share price by improving your governance, and we can give you some advice on how to do that. So this has been quite gratifying to find companies that are willing to listen to us and work with us. Of course, there are many other companies that say, thank you very much, we're not interested, and that's fine. We move on. So it's been quite gratifying in that sense. And now, interestingly enough, with the COVID-19 crisis, many of these companies are recognizing that it's very, very important for them to focus on the environmental, of course, the social, and most important, the governance aspects, because they're realizing that in order to survive, they're going to have to improve their governance, because investors are simply not going to be with them in difficult times. And that means either raising more capital or raising more debt or whatever it takes to survive in these times. So it's been quite an adventure. Of course, we've just been in business for a little less than 2 years, so it takes time to really build up the not only the performance, but the performance of the fund, but the performance of the companies themselves. But we're coming along very nicely, and there are a number of improvements that we've seen in this regard. Let me also say that we're focusing on emerging market companies. And by the way, the definition of an emerging market company is changing. When we started in 1987, it was very easy to define what were emerging countries. That was all of the low and middle income on a per capita basis countries and it was all of Latin America, it was all of Africa, it was most of Asia with the exception of Japan and Australia, New Zealand, and a lot of Eastern Europe. Of course, at that time, Eastern Europe was not in our purview yet. But then with the downfall of the so-called Iron Curtain and the blossoming of these East European countries, then they joined in the list of countries. But we're finding more and more that companies listed in New York or London and so forth, not only because these companies are emerging market companies, but because they're multinational companies that have become emerging market companies simply because over 50% of their assets or earnings are in emerging markets. So the whole picture is changing quite interestingly, and we're finding a number of companies that we can now define as emerging market companies simply because they are really making a big part of their earnings and a lot of their assets are in these countries. So we're very excited about this current situation, oddly enough. I know many people say it's a big disaster, it's a big crisis, but one of the things you have to recognize, just looking at stock prices, is that not all companies are in trouble. Many companies' prices have gone up, not down, during this crisis. And more importantly, there's so many companies whose stock prices have gone down too far, and that represent a very, very nice opportunity for us to pick up bargains, investment bargains. So, you know, I follow the old adage that my mentor, John Templeton, said. He said, to buy when others are despondently selling, and to sell when others are greedily buying requires the greatest fortitude, but pays the highest rewards. And if we keep that in mind, this time is quite interesting for us as fund managers. My 10 minutes are up. I'll now love to take your questions and comments and ideas. Let's begin. Thank you.
Thank you, Mark. So just going on to the last point, buying when others are selling and selling when others are buying. You know, we certainly saw an incredibly sharp sell-off through the end of March, but since then we've seen an incredible and seemingly unstoppable rally in markets. Now, you've recently indicated that that there may be a double dip. What are you seeing in terms of the possibility of a double dip and markets testing new lows? Do you think that the recent rally in markets and the recent buying activity is in line with the underlying fundamentals?
You know, it's very interesting when I made that statement about, you know, possibility of a double dip was based on some research that we just completed. What we did is we looked at 11 markets around the world, the US, Japan, Brazil, Russia, all of the major emerging markets, including, of course, China, Korea, Taiwan, and so forth. And we went back to 1987 and counted all the bear markets. Bear markets we defined as a decline of 20% or more. And we measured, first of all, how big the decline was in percentage terms and how long these bear markets lasted. By the way, a lot of people make the mistake of measuring a bear market from peak to peak. That's not the way to do it. The way to do it is to measure it from peak to the absolute bottom, because that is the time when you want to start buying. Because, you know, you only have to go from 1 to 2. If you've gone from 100 to 1, the percentage is what, 90 or whatever. But if you go from 1 to 2, that's 100% the increase. So you've got to go in when these things at the bottom of the bear, and the bear measurement is from the peak to the bottom. Anyway, the findings showed that on the average, the decline was about 50%. And the length of time was about 1 3/4 of a year. Now, of course, a number of emerging markets, Turkey comes to mind, that had many shorter bear markets, much more volatility. And of course, US was less volatile. But that was the result that we found. So when we had this bear market during this COVID crisis, I noticed the markets, not many markets went down 50%. US market went down, what, about 30? A lot of other markets didn't go down more than 30 or so. So I thought to myself, wait a minute, the 50 number has not been hit. Maybe we should be waiting for the next move. And of course, the other thing that happened is that the length of time was certainly not 1.5 years. It was like months. It was what, 6, 7 months. So again, I said, well, we've got to be cautious. So what I did is on my only personal account, which by the way, I can't buy shares. I buy emerging market shares. I buy funds and the regular non-emerging market stocks. So I put more or less half of what I had in cash into the market with the expectation that there might be another downturn. And in our portfolios, our emerging market portfolios, what we did was said, look, let's look at the stocks in the past that we really liked, but were too expensive at the time. And let's look at the stocks we have in the portfolio that we're not that happy about and maybe do some switching. So that's what we've been doing. And we haven't really increased the cash levels to any great extent. We have about, let's say about 10% in cash. And as you know, when you're running mutual funds, investors want you to be invested. So we try to be fully invested as much as possible. But the idea was to do the switching to take advantage of the downturn. So to answer your question, I'm still up in the air as regards to another possible dip. And the reason why I say that is not only because of the study that we did on bear markets, but also because I believe that as the earnings numbers come out, people will be rather shocked to see how badly the earnings have become for many of these companies. And of course, you already know, for example, the airline companies are in deep trouble, and a lot will depend on what kind of deal they make with governments on helping them with loans or whatever. So that's why I believe that you could see another shock, although a lot has already been in the market and has been expected, but we have to be cautious.
Mark, you also compared the current crisis and situation to 2008, and you highlighted the fact that in 2008, banks and financial services companies were the problem, and in this crisis, they are part of the solution, or seem to be the solution, to pumping liquidity into markets and trying to normalize. How do you see, do you mind unpackaging that for us? And how do you see that affecting the real economy? And how do you see that affecting different types of businesses potentially unequally between the small, medium, large cap companies?
Yeah, that's interesting. I do believe that the banks are part of the solution this time around, not the problem, simply because the banks are the ones that are going to be dishing out the loans and are going to be used by governments to help support businesses in various parts of the world. So the banks are sort of providing that liquidity to so many companies. Of course, the problem that you have is, on the one side, the governments are saying, look, you banks, get out there and make the loans and help support these companies. But the banks on the other side are going to say, wait a minute, look at our balance sheet. We have to be very careful. We have various standards that we have to meet that you, the government, have imposed upon us. So you've got to give us some leeway. And also you're going to have to back up some of the loans we're making and provide some guarantees. So in that sense, I wouldn't recommend wholeheartedly to be investing in banks, simply because they're going to be under this pressure. And you may see there, of course, you already know, their bad loan portfolio is increasing as we speak because of the crisis. But also you don't know to what degree the banks are going to be supporting them in the case of the increase in non-performing loans. So knowing that, we haven't really been too excited about the financial sector, but what we are excited about is, of course, technology, because now more and more technology is being used to communicate. The cell phone companies, the communication companies, and all of the companies related to cell phone technology. That would include companies making microchips, companies doing the software, video conferencing. All of this kind of business is going to be important. And then on the retail side, companies that are taking full advantage of the internet shopping and internet delivery and all the rest of that, that I think is still going to be very interesting. And probably after all this is over, they're going to reach a new plateau in terms of delivering services and goods to people around the world. So these are some of the areas that we're particularly interested in. Of course, healthcare comes to mind, but even there you've got to be cautious, because hospitals may be doing well when you look at the past numbers, but the fact that they were losing business as a result of COVID, because a lot of the beds were going to be reserved for COVID. So many of the operations were postponed, a lot of the treatments were postponed. So you might see some bad earnings coming from that sector. But then after it's over, they will pick up again. So many interesting areas, but I must say that we're better off looking at individual companies rather than trying to take a general view of a sector, because that's where you may be misled.
So we have a question from Mustafa in New York, and going on your highlighting of tech companies. The main beneficiaries of the bounce back have been large tech companies, as their business model and hence their valuations are being validated by the crisis. The market has also bounced back largely due to unprecedented stimulus, not necessarily because of economic reality. How do you see the opportunity in emerging markets in light of their inability to launch such stimulus measures and the general lack of market-dominating tech champions, or this is fairly harsh, innovation in general? This is a comment and a question, but what would be your response to Mustafa's question?
Well, first of all, I think you don't count out the emerging markets for innovation, because a lot of innovation in the tech area has actually come from emerging markets. Well, let's just take microchips. Which country is the largest, or at least one of the largest, maybe the second largest or the first, in the world for foundry for microchips? It's TSMC. It's a Taiwanese company, emerging market company. So, and you find that which company in the world pioneered the transfer of money using cell phones? Kenya with M-Pesa. So what we're finding is that, yes, a lot of the innovation is in Silicon Valley, in China. Of course, by the way, China is also an emerging market, so you can't count them out. But I wouldn't define the fact that emerging markets are devoid of innovation. There's a lot of innovation taking place. And more importantly, what's happening is that the emerging markets are leapfrogging. In other words, they're taking the very latest technology from Silicon Valley or elsewhere and jumping all over the steps that other countries went through. So, for example, there are many places in emerging markets where they didn't have a telephone system. There was no telephone system available. Now they're jumping into smartphones. They're not even going through cell phones, the old Nokia technology. They're skipping all that. So in that sense, I believe that the emerging markets are going to be in a very good shape as regards to the use of technology to overcome the COVID-19 crisis. The other thing that we're finding is that usually when we have a big crisis like this, emerging markets are the markets that recover the fastest. And if you look at history, you find that that is the case. This is partly because they fall the most. They tend to be the most, the exit. People exit from emerging markets first, and therefore emerging markets currencies and markets tend to suffer the most during a crisis. And of course, this happened to a great extent in this crisis. But then recovery can be very rapid and move up very nicely. So I believe that the emerging markets will probably perform better in the coming year, 2 years, as a result of this kind of situation. The other thing I think you've got to remember is that we're in a situation where the emerging markets are involved in the transformation in their traditional businesses. So the traditional business models have now been overcome with new technology. So for example, we're invested in a typical retail outlet chain in Brazil, but they have a subsidiary that does internet shopping. So that subsidiary now is moving faster in terms of earnings growth than the traditional business. So here's an example of where you're combining two ways of doing business, online, offline, but the online is growing faster. And that has nothing to do with what's happening in New York, London, or anywhere else. It has a lot to do with what's happening itself in Brazil and how they have adopted the technology.
So there's actually a lot of interest in our group, and there are a lot of attendees who have dialed in from India and quite a few from China as well. So if we can shift the focus and discuss a little bit more closely China, and there's a question from Dilip Mehta here in Dubai. China and the probable backlash it may face due to COVID. How do you see this impacting China? How do you see it impacting its relationship with the rest of the world? How do you see it, most importantly, impacting Chinese financial markets? And secondly, India versus China. How do you see India as being placed vis-a-vis the other emerging markets coming out of and throughout this crisis?
Well, it's true. You know, the Chinese have been accused of hiding information and various other things of developing this COVID-19 as a result of a military experiment, et cetera, et cetera. And no one knows the truth to that. But the bottom line is that I don't think you can accuse the Chinese now of not cooperating and trying their best to alleviate the crisis. So I don't think they will be blamed at the end of the day after this is all over for causing it. It's something that occurred, it's spread around the world. They did find solutions. As you know, they're getting back to work earlier than a lot of other countries. So I don't think that's going to be a big problem going forward. I think more and more people are beginning to realize that we all have to cooperate. We've got to open up. We've got to have more inter-country, international cooperation, and it's happening, by the way. There's a lot of communication between scientists all over the world, including Chinese scientists. But the other aspect of this is, of course, as a result of this COVID and the result of supply chains being interrupted, and with so many companies dependent upon Chinese components and materials, more and more companies are diversifying away from China into other areas. But by the way, this is a continuation of something that was happening already, in the sense that many Chinese companies' labor costs were going up. And in terms of the high labor input products, manufacturing was already moving out of China. Vietnam is one good example of that. Another example would be Bangladesh, India. So many other countries are now picking up some of this manufacturing from China. And by the way, there are Chinese companies that are moving into these other countries because they, in order to survive, they've got to, first of all, go around the US tariffs, and they also got to reduce costs. So you're going to see a lot of this taking place going forward. Now, does that mean that China is going to be in trouble? No, because China is moving into higher technology products. And of course, you only have to travel around the world to see that the Chinese technology has moved everywhere. You're seeing all kinds of Chinese telecommunications products in Latin America and Africa and so forth, all over the world. So that's where the direction China is going. Of course, you cannot expect the kind of growth rate that China had in the past. You know, a lot of people forget that in 2010, a 10% growth rate in China in dollar terms is smaller than 5 or 6% growth rate now, because the bottom line, the base of the Chinese economy has expanded so much. So we have to expect, you know, 4 or 5% growth in China coming down the line. So now, in terms of India, of course, India is going to be a beneficiary of these supply chain problems. I don't know whether you've noticed, I think there's a report just recently about Apple moving into India with tens of or hundreds of billions worth of manufacturing. Of course, they'll still be in China, but they're moving a lot into India. Not only because there's an imbalance of their sales in India and their manufacturing, which I think the Indian government would like to remedy. You know, they've got to manufacture more for that Indian market, but also because it's going to be cheaper for them and it's going to diversify their supply chain. So again, Apple is just one example. You're going to see more examples of that. And it should be for the benefit of India. India should benefit from this kind of trend. And I believe that at the end of the day, you must remember that the multilateral institutions supported by the major countries around the world are going to be pouring a lot of money into these emerging markets. I'm on the advisory board of economic advisory board of the IFC, International Finance Corporation, and recent discussions there indicated that they're going all out to help these countries improve and get money to them to not only stabilize their debts, but also to improve their infrastructure, to spend more on things that need to be done, and also institute more reforms. So it's going to be very important going forward.
So just expanding on that, let's also talk about the liquidity and dollar shortage that we're facing in emerging markets. A question from Ali Al-Salim cites this and is asking if swap lines, in addition to the measures that you just mentioned coming out of the IFC, is this going to be enough to ease the stress? The BIS, Bank of International Settlements, has cited elevated corporate liquidity shortages and refinancing risk in large economies such as Turkey, India, and Brazil. So again, cash is king with a lot of dollar-denominated debts in the emerging world. Do you see challenges in liquidity beyond the stimulus measures, and do you think that these short-term liquidity measures are going to be enough to support these economies?
Say liquidity is not going to be a problem. There'll be plenty of liquidity, but that's not the solution. The solution is you've got to get people back to work, because you can have plenty of dollars or whatever currency you're using in the bank, but if you can't go out and spend it, or if you've lost your job and are afraid to spend because you don't know how you're going to survive going forward, then you're not going to get any recovery. So, you know, as I said, the banks are part of the solution, but they're not the full solution. The full solution will be to get people back to work and therefore get the economy moving again, get retailing moving, get wholesaling moving, get supply chains moving, et cetera, get transportation moving. So that to me is the biggest challenge, and I don't see any recovery until such time as governments around the world take into account what is happening on the ground in terms of the market. One of the interesting parts of this is that, unfortunately, I believe that governments have been taking a lot of advice from very smart scientists who, by the way, all don't agree on all aspects of this crisis. But they haven't really talked to sociologists, psychologists, and other people who can give them an understanding of the impact, sociological, psychological impact of these shutdowns on people's lives. And I think this is one thing that has to be taken into consideration.
So you discussed the need that banks can't be the whole solution. If we just pump liquidity into the system, that's not going to be enough. We need to get people working. We need to get the economy running again. Now, what are the concerns that you may have about this liquidity and economic reality becoming a mismatch? One of the questions from the group, from Mark Woolhouse, is, are you concerned about the return of inflation being driven by the huge money printing being done in response to the COVID-19 crisis? And expanding on that, there's several questions about gold and some of the potential inflation hedges, even Bitcoin.
I'm not afraid of inflation. In fact, I'm coming out with a book now called The Inflation Myth, where I contend that there is no inflation. Inflation does not exist. Money printing exists, devaluation of currencies exists, but there's no shortage of goods and services. And the reason is that the technology that we've achieved in the last 100, 200 years has continuously improved the lives and supply of goods and services. So that's not going to be the problem. The inflation is not going to be a problem, even though you may find, hey, oh, I have to spend $200 on a hotel room instead of $50. It may seem like inflationary, but it's really because of the devaluation of the currency. They're printing like crazy. And of course, another aspect of this, if you talk about Bitcoin or any of these other currencies, no one really knows what the money supply is anywhere in the world. Nobody knows. So therefore, the money supply, I don't think, is going to be a determinant. The determinant will be the ability of people to get out and spend and to work.
So just expanding on this further, Mohammed El-Arian has actually expressed concern of structural damage caused by massive QE and the infliction of potentially further crises from the money printing that could lead to us ending up with zombie companies. Again, the Federal Reserve in the United States is now participating in primary markets, in junk bonds. What are your concerns about zombie companies, and whether or not we can actually trust valuations any longer?
No, that's a very, very good point, and the big question, because what you're doing now with these bailouts and these handouts and so forth is destroying the system by which we operate. You may call it capitalism, you may call it whatever you want, but the bottom line is that the reason why we've been able, the US as an example, has been able to build this incredible economy is because you have had a measuring stick. In other words, if a company was not did not have good productivity, had bad balance sheets, wasted a lot of money, they went bankrupt. And therefore, the economy became much more efficient because the survivors were able to improve their productivity and do better in terms of their balance sheets and so forth and so on. So with this situation of bailouts, you are basically destroying a system of the economy. And that is, I think, a big danger. In fact, a lot of people talk about the financial crisis, the previous crisis that we had, and how banks were bailed out for no good reason. In other words, they do feel that these banks should have been allowed to go bust. Of course, you protect the depositors, but none of the bank officers were punished for what happened. And of course, they made big mistakes. So I think we're in another phase of that similar kind of development, which is not good when you consider how these economies are run and how we can improve creativity, productivity, et cetera, et cetera. So I think he's made a very, very good point, something that's really got to be considered carefully. The other aspect, by the way, is the degree to which the governments are going to have more and more control over our lives. Because if you begin to institute mass surveillance, a embedded identity into your skin, and whether you have had the virus or not, you begin to threaten the freedoms that people have. And that's something we've got to really consider very carefully.
So myself and a lot of the viewers are sitting here in Dubai. I know that Dubai is a special place in your heart. You were mentioning before the call, you actually have a couple apartments up in the address next to Dubai Mall. What is your view on the economies here in the Middle East? And they're facing this kind of double whammy, or some have called it a double pneumonia. Deepak Ahuja calls it a double whammy of both the hit to the economy from COVID, but also another hit from oil prices. So what do you see, and what's your view on the Middle East and how economies are being hit here? You may have also seen the announcement this morning of Saudi Arabia tripling the VAT tax, which is again a counter stimulus. It's a depressing measure on the economy. So what are your concerns in this region, in the GCC and in the Middle East economies, particularly those that are driven by oil?
First of all, I believe the oil prices will move up. I don't think they'll stay low. In fact, I made a bet that when it was about 20, I thought it would probably go to 40 or more going forward, because the demand for oil, again, it depends on how fast people are able to go back to work. Because as soon as people begin to have the freedom to go to work and to travel, et cetera, the demand for oil is going to be increasing pretty dramatically. So I believe the oil prices will continue to go up. As regards to the Middle East, it's interesting if you consider the behavior of people in the Middle East is quite disciplined. I find that it would be quite easy for them, and it probably has been easy for them, to discipline the spread of the disease. In other words, minimize contacts, et cetera. So there'll be a good chance, I think, for these countries to move out of the confinement that we're now facing. As regards to the VAT in Saudi Arabia, I'm not sure the reasoning behind that. We have to look at the other side of the coin. They may be reducing taxes in other directions to help companies, but that's something we have to look at. I'm not so sure about what that's about. Of course, it will be impacting shopping, and maybe it's a way to discourage people to go to the shopping malls and go shopping, but there probably is some other thinking behind that.
So the Middle East, Dubai and UAE in particular, have also actually recently been hit by major corporate governance scandals, corporate governance related scandals that have been terrible for the markets and for investors' faith in some of the companies out here. What would be your recommendation to companies in the Middle East and in the GCC? How do you view them in line with the ESG principles that you follow? And how might companies be able to take this as a valuable lesson on how they can improve those measures in order to attract capital and better valuations in the future?
Well, first of all, this is a global issue. I mean, it's not only in the Middle East, not only in India, not only China. You get scams all over the world. So that's something we have to keep in mind. But I believe that more and more companies are going to realize that if they can improve their corporate governance, which means, by the way, better transparency, they will be able to improve their share price, and they'll be able to improve their ability to survive under these conditions where they need finance or whatever. You know, one of the things that I learned in dealing with the multilateral institutions like the IFC, World Bank, and so forth, is that they are more and more looking at conditionality. In other words, they're saying, look, we're happy to help you out and give you this money, but we want you to improve law and order. We want you to improve the governance of not only your companies, but also the country, how you manage your finance, et cetera, et cetera. How do you go after graft and corruption? So I believe that there's a great opportunity for these companies in the Middle East, not only in the Middle East, but everywhere in the world, to address it. And one of the ways to do that, to begin with, is go down the list. There's a checklist of looking at corporate governance, and ask yourself, how many of these points on the list do we address and do we satisfy? And if the number is great, then you can publicize that and say to people and shareholders, look, this is what we do. We have independent directors, we pay dividends, et cetera, et cetera. And that puts you on a higher plane than other companies, and it will help you a lot. And I believe that's what's happening now. People are paying attention.
So, what else do you think that companies can do, and what can investors look at? What are some of the metrics, in particular? You mentioned numbers of independent directors, but what is a guide for someone to invest in ESG principles that you follow or adhere to? And what else can we look at as investors in order to, again, even if the E and the S may not be as important to some, G, investing in companies with good corporate governance, particularly in emerging markets, is critical. So what are some of the other measures that you would look at as an investor, and again, as a company, in order to potentially improve?
Well, the first thing we look at is, what are they reporting? In other words, we look at their website, we look at their balance sheet, we look at their annual report, and more companies are now having a special section on what they call sustainability, which includes environmental, social, and governance issues. So there are a number of companies that have explicitly stated where they stand on these issues. The other thing we look at is the ratings. As you know, MSCI, there's a number of sustainability indices that you can look at where the companies are rated. So that's another measure they can use to separate the men from the boys, so to speak. The other thing you can do is, of course, we talk to all these companies and we ask them, look, why don't you have independent directors on your board? And they will give you sometimes a very reasonable answer of why that's not the case. But this is the kind of thing you can do to really determine what the intentions of the companies are and where they're going in terms of improvements going forward. So I would say the number one measure to begin with is transparency. That's very, very important. And then you've got to check out the transparency by independent means.
So which countries in emerging markets do you think have the most ability to continue to tap into capital markets and borrow in order to support their local economies? One question actually did ask to specifically highlight India, given the current debt to GDP ratio of 69%. Should India and countries like India and emerging markets be borrowing and deploying capital into their economies in order to support jobs and create demand?
Well, I think at first order of business for all these countries, including India, is, and I think India has been pretty good in this regards. They're not depending upon foreign currency loans. That's very, very important. I think for all countries, they should be borrowing locally in local currency. And a lot of people say, oh, there's no capital locally. No, there's plenty of capital. There's a lot of capital hidden under the mattress. And of course, if you look at India alone, you know there's an incredible amount of wealth that's hidden, that is not in the public domain. So the degree to which you can give confidence to local investors to buy local bonds in local currency, that is really the way to operate, because this way you're not going to be subject to currency fluctuations. Okay, you can bring in foreign capital, but that should be equity capital. In other words, capital that doesn't necessarily have to be paid back. But in order to get equity capital in foreign currency, you got to give confidence regarding the rule of law, et cetera, to these people that are bringing money in. But by the way, one of the things you've got to remember, there's always capital available. There's no shortage of capital. The problem is what kind of risk do the investors, are they willing to take? In other words, if the risk seems to be high, you will always find someone to lend, but at a very high interest rate. It all depends on the rate. Now, one of the challenges with the capital markets is that although equity markets, stock markets are quite liquid and transparent, the bond markets are not. And this is one area where I think the multilateral institutions have got to do something to increase the liquidity and transparency of the fixed income markets around the world.
If you had to pick one Asian emerging market as a high conviction value bet for the next 5 years, which would it be and why?
Well, I think you've got to look at potential growth, you've got to look at size, you've got to liquidity, and it's impossible to give a straight answer to this because we're looking at many, many great companies and many companies in countries where you would be very suspicious to put your money in. But I have to say India is probably at the top of the list because it's big, it's a potentially very, very liquid market, and it's a market that is growing at a fast pace and will benefit from the innovations that are taking place around the world. But I hate to give one country because it's quite misleading. There's so many other countries, and if you can just look at our portfolios, we're invested in many different countries. We're in Korea, we're in Taiwan, of course we're in China, we're in Turkey, we're in Brazil, we're in South Africa, of course we're in India. So it just depends on the individual company.
Which countries have you seen companies be ahead of the curve and most progressive in terms of applying the best ESG standards, and which ones do you think are laggards in the emerging markets universe?
Well, I would say probably Korea and Taiwan are right up there in terms of their transparency, their corporate governance, mainly because of what's happening in the country itself. Standard of living's going up, and there's a lot of attention being paid to those issues. I would say those are the two countries that come to mind immediately. The worst, I can't really name the worst. There are problems in every country around the world. I think, let me put it this way, the challenges that countries face at the top of the list maybe would be South Africa, Nigeria is right there. Turkey, of course, is facing a lot of challenges. But mind you, we're finding great companies in all of those countries. So we don't make a country distinction in that sense.
So what maybe if you could give us some examples, tell us about some of the companies that you follow, that you've invested in, that you think not only have been able to outperform, but have actually been able to outperform particularly because of their adherence to these ESG standards and principles.
I don't want to mention names because we may be involved in buying or selling them, but let me say this. There are a number of companies that have been improving their corporate governance standards at a pretty rapid rate. And you're seeing a lot more transparency in these companies. If you just pick up their annual reports, you'll see they're paying a lot of attention to what's happening. Just to give you one example, in Brazil, if you look at a company like Lojas Americanas, they become I'm not saying they're perfect, but they're becoming much more transparent and much more open regarding corporate governance and sustainability. But there are many, many examples like that. If you look at our portfolio of companies, you'll see that most of them are improving and have pretty good standards of corporate governance, but are improving. All of them need to improve. There's no question about that.
So let's talk for a second about how the E in ESG is being impacted by the huge and unprecedented fall in conventional and non-clean energy prices. Is this having any spillover effect on companies that have been ahead of the curve on improving their sources of energy to clean sources? And has it changed the economics of the E in ESG?
You know, it's interesting with the fall in the oil prices, which impact all kinds of other sources of fuel. You're going to see a real problem in moving into wind, solar, and other non-polluting sources of energy. So on the one hand, the lower oil price has been a boon to many of these countries that are big importers of oil, like India, China, etc., Turkey. But that also means that these countries are going to be discouraging from moving too fast into renewable types of energy. So hopefully the oil price does not stay. As I said, I think you'll see $40 plus in the not too distant future. When that happens, then people will get back to work and say, okay, we're going to continue to invest in wind and solar. But you must remember, if you look at the major countries around the world, in China and India, what are the main sources of electric power? The source of energy is coal and oil. Coal is still very, very big, and you see that in South Africa as well. Sure, they do have nuclear. They're starting out in wind and solar, but the big source is still highly polluting sources of energy. So it's going to take time for them to switch over. It's happening because the costs of wind and solar are going down, beginning to match the traditional sources of energy, but the capital investment required for this kind of investment is a real problem. And by the way, this is why the opportunity now for the multilateral institutions, the World Bank, IFC, etc., European Union, to give money for these countries to produce the non-traditional sources of energy, solar and wind, to increase those two sources is a great opportunity. So that's where the money could be spent. And it achieves two things. One, it helps solve the pollution problem. And two, it provides a continuing source of energy which would not be available to them if prices go up.
Well, Mark, this has been absolutely incredible. I can't believe that an hour has flown by. Having a discussion with you again has been such a unique pleasure. I thank you on behalf of everyone. Again, for everybody who dialed in, I'm so sorry. There were so many amazing questions here. I did my best to address as many of them as I could. And we'll look forward to, feel free to email us for any of the questions, and we can potentially see if Mark might be able to address some of them offline. We provided a survey for anybody who's interested in learning more about Mobius Capital Partners and about ESG investing in general. So we're really looking forward to connecting with you on future webinars. Just to hand over to Mark for some final closing remarks. Again, we discussed quite in depth what's happening in emerging markets, what's going on in the COVID crisis, what the opportunities are, what the risks are, and you gave us such a good macro view. But going back to the original title and the original topic, we also discussed ESG and investing on ESG principles. And what you really explained is that it's not just about the good and investing for the good of society, it's actually a great way to make money investing in emerging markets. Companies that follow strong ESG principles have a tendency to outperform. If you wouldn't mind kind of just giving some closing remarks on the philosophy of investing for good and what it means beyond the fact that it's been able to just generate good returns, but what it means for investors being able to feel good about the companies that they're investing in and make a positive impact through their investments.
Yeah, I mean, as we pointed out in the book, Invest for Good, the companies can perform better with better ESG characteristics. But it's really an interesting development because when we talk about the social aspects, companies begin to pay more attention to the workers, the people that work for them, and begin to look after their health and their well-being. And of course, this creates a completely new atmosphere within these companies, and they're discovering productivity goes up. So that's another aspect. And then if you look at the environmental, it's not new. We used to look at the environmental aspects back in 1987 because we realized this was a risk to a company. If they're polluting the environment, they could have real problems going forward. So I believe that the opportunities are really, really good at this, particularly at this stage with the crisis, for companies to sit back and think about the ESG characteristics. And by the way, we do have a blog, we have Twitter and so forth. If any of you have questions, be happy to answer them. You can put them on those sources. The great thing about this crisis is that we become much more efficient in doing long distance communications, and we're actually beginning to change our model of operations as a result of this. So it's been a blessing in disguise. And the bottom line is that, look, the world belongs to optimists. You have to be optimistic because at the end of the day, markets do go up. And the way to defend yourself and your savings is to be invested in good companies. Thank you very much.
Thank you so much, Mark. Cannot thank you enough. Again, for everybody who dialed in, thank you so much for joining us. Please be sure also to join another webinar taking place tomorrow on cryptocurrency and Bitcoin mining and whether this is becoming a new asset class for institutional investors. Also, next week, we're having a session with His Highness, the Prince Michael von Liechtenstein and Mishal, Kanoo, how family offices can navigate the current crisis, happening on May 14th. And then finally, we'll be having another discussion on the 19th of May, have central banks and policymakers failed? That discussion is being led by Dr. John Rutledge and Dr. Ryan Lemand. Please join us again. Thank you all so much. Thank you, Mark. It's always a pleasure having you. Again, you're somebody who I admire so much and really model myself on, not only as a money manager, but as an entrepreneur. So it was such a pleasure having you, and I look forward to speaking with you again and hosting you all again for our next webinar. Thank you all.
Thank you.